So I've looked at the difference there. Really, there is no difference. Is Forex trading the same as a CFD? So this is what I'm going to focus on for the rest of the talk. But my position really is that in the vast majority of cases, retail Forex trading, right? Retail Forex trading is exactly the same as a CFD. In the vast majority of cases, this is true. And of course, I've just said, CFD is the same as spread betting, which is, really it's betting, it's gambling. So let me explain that in some more detail. Is a CFD halal? Okay, so we can say this is what the whole video series is about. I mean, are they halal or not? My view is, so ignoring retail Forex trading for now, let's look at CFDs. Are they halal? I mean, the answer has to be no. And this is not me giving my opinion. I don't like to give my opinions on these things because I'm not a scholar. It's not my opinion. So when I say no, what I mean is the vast majority of scholars that I know that have given an opinion have said it's not halal. They've said it's haram. They say Forex trading is haram. Okay. Now, in my view, that position is correct because Forex trading, the vast majority, not always, vast majority of cases is a CFD. A CFD is pure betting. So if betting is haram in Islam, then a CFD should be haram. So some scholars have said yes. I mean, a very small number of scholars, and this is really anecdotal for me. I've heard in some places that, in some countries, that some scholars have said yes. I have never seen an opinion, written opinion. I've never seen one that says it's halal, but I've heard that there are scholars, so I've never seen one. I've heard that there are scholars who said yes. I have actually seen one or two explanations given by scholars linked to an opinion, and where there's been uncertainty on behalf of the scholars, that's often because their understanding is wrong of how CFDs work, how retail Forex trading works. But all the opinions I've seen, the meaningful opinions from scholars who are credible, they've all said no. But the interesting thing is that the reasons they give, sometimes they're correct and sometimes they're not correct. Right? The outcome is, my view, is correct. If they say it's not permissible, it's haram, I agree with this. It's not for me to say things are halal or haram, but I agree with this. For me, there's no doubt. There really can be no doubt once you understand how the products work. There can be no doubt that CFDs are pure gambling. But some of the reasons given for why retail Forex trading has been deemed to be haram by certain scholars, some of the reasons are not correct. Right? But their conclusion is okay. Okay. Okay, so let's talk about Forex transactions now. So we need to make clear that there's a difference. So we have the FX market, which is a huge market, and we have the retail Forex market. Okay, so we have to be clear that these are two different markets. These are not the same thing. And this is where a lot of confusion comes in. Right. And I'm speaking, so, many of you might not know my background, but my background is in banking. Right. And I worked in Islamic banking a long time, but I worked in conventional banking quite a long time before that. And I was a trader on the trading floor, in the dealing room, and I worked at banks like UBS and JP Morgan on the trading floor in London. And so I traded and sold and bought and took positions on many instruments, some simple, some complicated. And I don't think I actually traded FX, no. I traded more complex positions because FX is very simple in the investment banking market, not retail market. But I know how the markets work, and the Forex market is one of the most simple markets that you can find. So what is the FX market? Foreign exchange market is simply the trading, the buying and selling of currencies. So you just buy and sell currency, right? And you actually buy and sell real currency, right? So let's say you buy, let's say you have £1 million and you want to exchange it for dollars. I'm not sure what the exchange rate is, so maybe you get $1.2 million. So this is what you actually do. So somebody, sells GBP and the other party sells dollars, right? So this party is buying dollars and this party is buying GBP. So this is an exchange of currencies. You say, I'm going to sell you this amount of money and I'm going to pay for it in this amount of money. You exchange the cash. There's a full exchange of cash. Right? So this is not really trading. It's doing a transaction. It's a sale transaction for currency against currency. And we have certain requirements of this in Sharia. Right? So this is an FX spot transaction. And the major requirement in the contracts of sale to do with currency, to do with ribawi commodities, is that it must be hand to hand. Right? You can agree any rate, any price, but hand to hand means immediate. And in the foreign exchange markets, immediate, in theory we say now, it's going to happen now, but you have settlement often in currencies. So, it can be T plus 0. So the day you trade, it can be T plus 1, T plus 2. Each currency has a different convention. So you follow the convention of when the money is actually sent, but all the legal obligations are entered into immediately now. So generally in FX spot transaction, even if you settle 1 or 2 days later, which sometimes you have to because of the markets, then this is often seen as halal. And this is often, this is not controversial, right? So when we talk about the FX market, foreign exchange market, and you do spot transactions, and there's really no controversy amongst the scholars here that this is halal. You pay immediately, you agree the price, you buy and sell the currency, you have to settle the currency. There's no uncertainty, there's no gharar, no uncertainty, no ambiguity, and the transaction is hand to hand. So this is a spot transaction in the foreign exchange market. So you're actually settling the full amount of cash. So now we look at Forex trading. This is very different. And I think this is where a lot of the confusion comes from. So now we look at Forex trading. I'll put retail Forex trading, because this is what people like you and me do. We're not institutions that, like investment banks and foreign exchange trading houses where we buy and sell currencies. We do retail trading. So here, let me tell you what doesn't happen. I'll put across here. We don't get any spot transactions. We don't get any FX spot transactions like I mentioned with hand to hand. This does not happen. So where I gave the example of this is pounds, £1 million for $1.2 million, an exchange of these currencies, this does not happen. So what happens instead? What happens instead is that, in every instance that I've ever come across in retail Forex trading, and I've been a trader myself, I did trade Forex for some time, many years ago, before I really understood the nature of it. And to be honest, before I was a bit younger and I was trading, and before I was that bothered about halal or not. So I do know how these work, and I've also spoken to many brokers, and I look at the information provided by all the brokers, and every single one I've come across, they trade via CFD. They do Forex trading via CFD, right? They do not do spot transactions. And remember, I've already said CFD is simply betting. So retail Forex trading, this is what I've just talked about. So why is it called retail trading? So this is a bit of a diversion, but it's an interesting one. It's because, in the foreign exchange markets, you get often this large amount of currencies taking place. So I mentioned millions. So when I worked when I was a trader in banking, I did various things. But when we came to the aspect of money and the size, it had to be quite large, because otherwise it's not worth it for the large banks to do it. And we often, if anything was under £1 million, I was based in London, so our base currency was pounds. Actually, it was dollars as well for the American bank, but let's use dollars. It was more often dollars than pounds. If it was under £1 million, really, it's not worth it. The banks wouldn't do it. And the desks I worked on, we had, $5 million is really where we would be potentially interested, but it's a bit boring because there's not much margin in there. Margin in terms of fees, you make a small percentage commission. So we would do it for regular clients, but otherwise it would be $10 million and more for the large institutions to accept trades. So when we look at retail trading, like people like you and me. So we're never going to be in a position to do spot transactions like this, are we? So the whole foreign exchange market created a way for retail traders to come into the market. And why did they do that? Because it's a way to take money from people, right? Because people in general are not very good traders. This is why 80 to 90% of all traders lose their money. So the providers of these platforms. So when they lose the money, I mean, who makes the money? It's the platforms, the provider of the platforms, or the brokerages, for example. They make the profit. So they're the ones who make it as easy as possible for retail traders to come in, because it's a distribution of wealth. So what they do is you can trade retail. You can basically have low barrier to entry. Okay, so instead of saying you do a £1 million transaction, they say you could open an account with £100. Right, and often, to get you in, they give you free demo accounts, and in the demo they can give you anything, 100,000 units, whatever, pounds to trade with, to demo, to try. But you can, £50, £100, you can probably open one with less. You can probably trade with £20, £10, whatever. So there's low barrier to entry, and then we have a way to make it interesting, to make it profitable. Profitable for who? So you have to have the chance to making profit. So if you say to a retail investor, you can invest £100, and you have, if you do a lot of trades and the market moves 1%, you can make £1 if you're correct. This is not that interesting to most traders. They want to, most people are crazy, right? Most people want to double their money, double the £100 in a week or something. So they want to give people the opportunity to be profitable, but in reality, they're going to lose money, most of them. So what they do is they use things like leverage and margin, and I will explain what these are. So they let people trade with low amounts of money, and then in order to enable them to make potentially a high profit. So if you say £1 to somebody on £100, it's not that interesting. But if you say to them, potentially if you get things right, you can double your money in 1 week. People are more interested, and of course they're still going to lose their money. But in order to facilitate the doubling of the money, this kind of thing, so brokers and platforms offer leverage and they offer margin. So these are some of the terminology that I'm going to come back to, and these are the clues to look for. So essentially, when you see this kind of terminology, leverage and margin, this is really a CFD. So I've explained buying the underlying currency is not possible. Instead, we buy a leveraged derivative. So it's as easy for me to say, and I'd rather explain through an example. So how does a CFD trading currencies work? Currencies are divided into lots in the foreign exchange market, and each lot is often 100,000 units. Right. So if it's GBP, you can buy lots in sterling or US dollars, for example, or euros, and it'd be 100,000 units. And so if you go to a retail trader and say, look, you can buy lots in or sell lots in pounds sterling, but you need 100,000 for one single lot, then that's too much money for people. So this is why I mentioned just now things about leverage. This is why leverage is introduced. So how can you trade this with £100? I mean, you can trade it with £20. So how can you get exposure to something with a minimum size of 100,000 with an investment of £100? So this is through CFD, right? There's no other way to do it. So what they do is you look at the rate. So let's just make up a rate. Let's look at the pound dollar rate. So let's say £1 is, just for illustration. Okay, so £1 equals $1.20. Let's say this is the case. So let's say you want to take a position on this. You want to trade because you think the price is going to go up. So you want to take a long position. If you think the price is going to go down, you can take a short position. So short positions in general are not permissible. But in this case anyway, this is a CFD, right? So the whole concept of long or it really doesn't matter because CFD is betting anyway. So, but when you're trading assets in general, like stocks, you can't really take a short position. But that's a different matter. This is in Sharia, in Islamic law. You can't sell what you don't have. So we look at the long position in sterling. I mean, this rate. The reason I hesitated in calling it sterling dollar is that I'm used to the old school technology, old school labels, and we call it cable. This is what we called it in investment banking. Cable is pounds against dollars. So you have £100, so and you want to take a position at $1.20 per pound. You think the price is going to go up, so you're going to buy the position. But what do you buy? So you don't. First of all, you don't buy currency. Right, you're not buying dollars, you're not buying pounds, you're not selling anything, you're doing nothing, you're just taking a position. So remember how I explained a CFD is based on the position. So you're taking a position and your base position is this rate, $1.20, and you think it's going to go up. I mean, in reality, it can go down. If it goes down, then you're going to make a loss. If it goes up, you're going to make a profit. And then now you've got to have your stake on how much you want to bet for each movement up. Right, so remember in the rain scenario we looked at what was it, £4 per day, something like that, for each day you were off. So here you got to now take a position. So if the price goes up, price moves in basis points. Okay, so let me explain. Pips. Okay, pips is a technology used in retail trading. I'm used to investment banking terminology, so I call it basis points or bips. But pips is used. So what is 1 pip? So when I say 120 here, the price is quoted to 4 decimal points. So one pip is a movement to this, and if it goes down by 1 pip, it's, let me get this right. Okay, so this is +1 and -1 pip. Right, so this is the units in which price can go up or down. This is the smallest unit in which price can go up or down. So then you've got to take a position per pip. So you've got to decide. So instead of per day, you've got to take a view of how much per pip you want to win or lose. So this is how you take your position. So this will then translate to what lot size you want to buy. And of course, you can't buy one lot because you don't have £100,000. So then this is translated by leverage. So if, for example, you want to buy one lot, if you want to buy a position of one lot, exposure of one lot, you don't have to. I think you can buy mini lots or 0.01 lot depending on your broker. But let's say, so we know one lot is a position of 100,000 units. So let's say it's pounds. And if you have £100, then you can only get exposure to the return of a position of 100,000 if you have 100, if you have 1,000 leverage. Right, so that becomes 100,000. Now 1,000 leverage is quite high. When I was trading early, many years ago, 500 leverage was possible. But now the regulations have changed to make it less risky for investors, because leverage is just a quicker way to lose money. So now you'll see, some might use 200, I don't know, but 50 is quite common now, or 100 leverage. But it used to be 500. So if you want to buy one lot and you have £100, you need a leverage of times 1,000 to buy one lot. So if your broker is giving you a leverage of 50, for example, so then the exposure that you can buy is 100 times 50. I'm just giving this in very simple terms just to help you to understand. So what is this? 5,000. So if one lot is 100,000, all right. So with 5,000 you can buy 0.05 lots, I think, if my math is right. So then that's how much you can buy based on your maximum potential loss. And then the price will either go up, right? So we started at 1.200, and then the price can go, let's say you're correct and it goes up by 10 basis points. So 10 pips, sorry, this is your profit, and then you'll make a certain profit based on your lot size. So your lot size, which is your percentage of one lot, times by 10 pips. And there's a formula that you can use to work out your profit, but it also is your loss, right? So if it goes down 10 basis points, 1, 9, I think this is minus 10 pips, isn't it? Yeah. So then you're going to make a loss. right? So we've used leverage here of 50. So what this means is that you're effectively, compared to investing £100, we said was our amount we had in the account. So what you're doing is, by leveraging, you're multiplying by 50. So even though you start off with £100, but your position is based as if you had £5,000, right? So your profits are 50 times larger and your losses are 50 times larger. Okay, this is the effect of leverage, and this is why you can get an exposure of £5,000 based on not investment. Investment's the wrong word. Based on an amount in your account of £100. So this is sometimes it's referred to as margin. This is the amount of money you have to place in margin. And if you're making profit, you'll make profit. You close your position and you can take some money. So your £100 will be higher now. But if you're making a loss, what will happen is your £100 will be reduced. And if you hold the position too long, which a lot of traders do, then your margin will be reducing with your loss, right? So if you hold it for too long, then your loss will reach £100. So £100 is what you had in your account. So once that is gone, then your margin is zero, right? And then what happens here is that there's a margin call, right? There's a movie. It's a very good movie, Margin Call. And either you put more money in your account as margin, or you don't. And if you don't, then your position is closed, forcibly closed by the broker. Okay, so you've taken an effective position on a position size of 5,000 based on an investment of 100 due to leverage of 50. So this concept of leverage, as I mentioned, and here this concept of margin, these are both often, they're associated with CFD. We don't get this language in the regular FX spot transactions I mentioned, where large institutional buyers and sellers of currency actually buy and sell currency. You don't need leverage, and you don't need margin. They don't have either of these. This is only for retail Forex trading. Right. So these are some of the clues that if anything operates anything like this, then we're talking about CFDs.